backyard, but at least you'd have the $100,000 in my example a year later. But with a digital account, they can actually take it out of your account. Number one. Number two, they can put a timestamp or an expiration date on your money and say, okay, here's your money that's in your account, but if you don't spend 10% of it in the next 30 days, we're going to impose a 2% penalty. We're going to take it away basically if you don't spend it. Oh, what does that do? It kind of forces you to spend it. Is that a kind of stimulus? Maybe, I'm not sure. These things don't usually work out as the eggheads plan, but the idea would be if we don't have enough what Keynes called aggregate demand, we'll force people to go buy stuff by telling them if you don't spend it, you lose it. Use it or lose it kind of thing. Okay. Withholding taxes. Now, again, in the United States, I think it's similar in Australia. If you have a job, quote unquote, your regular payday or whatever, they pay you, but they deduct the withholding tax at the source, and it's based on the rate. So maybe it's, 20%. So you make $1,000, they take out $200, and here's the $800 net to you. And then at the end of the year, they give you a statement, and you file your tax return, and you claim the withholding, and you reconcile your taxes. But that's not true for independent contractors, doctors, lawyers, professionals, writers, anyone who you earn a living, you work, right? But you don't have any withholding tax. But you still have the money still goes in your bank account. Well, now they can just impose the tax on your bank account. Say, well, hey, we see your inflows here. You make a nice living. We're going to take 20% of that. Again, we'll send you a tax receipt, and file your tax return and sort it out at the end of the year. That would come as a shock to a lot of doctors and lawyers. So negative interest rates and withholding taxes are two things that are hard to impose if in a world of cash and non-central bank digital currencies, but they're easy in a world of no cash and central bank digital currencies. Well, it gets worse. This is the culmination, just kind of cut to the chase. This is the culmination of the total surveillance state. We already have facial recognition software, very good. It's like your face is like a fingerprint. Everyone's a little different. You say, well, that's okay. I'm going to put a mask on because COVID, and sunglasses, and pull a hat down to my forehead. You'll never see my face. You know what? They have gait recognition software, GAIT, meaning how you walk. Everybody walks differently. It was that Monty Python thing, the mystery of silly walks? Well, silly or not, everybody walks differently. And so they can actually digitally identify you just by the way you walk. And so your mask isn't going to help you. And with GPS, I have a bunch of what are called Faraday sacks. They're, some of them are nice, they're leather wallets, but they're basically lined with a certain metallic fibers that block radiation. So if you want to turn your cell phone off, put it in a Faraday sack, and by the way, do the same with your Easy Pass and any other things sending out radiation, which are ubiquitous. Maybe they can't follow you around, but most people don't do that, and they do. And so with your iPhone, they know where you are at all times. You may be looking at a map trying to find a good restaurant, but they're tracking you. So they already do that. But now they take it a step further. So you're at the point of purchase, you're buying a book. Let's say it's a book that criticizes Kevin Rudd, for example. He's your leading panda hugger down in Australia, or in the United States, criticizes Joe Biden or something, or ultra MAGA hamburger, whatever it is. Well, ultra MAGA, you're an extremist, you're a radical, you're part of the insurrection. So now we're going to freeze your account, or deny the purchase, or put you on a watch list, or we just appropriated money to hire 87,000 armed IRS, Internal Revenue Service agents. Maybe we'll assign one to you because you bought the wrong book. So now we're into thought control. We're into basically subduing your political enemies, because well, if you give money to a certain political candidate, again, perfectly legal stuff, buy a book, make a donation, that's legal. But they don't like who you're doing it with. And they meaning the government, they're watching. They know what you're reading, and by inference, what you're thinking, who you're giving money to, what causes you support, et cetera, et cetera. And it doesn't take much these days to have some kind of low IQ spokesperson of the White House label you as an extremist. So this is all government's ever wanted, was total control of the people. Makes Louis the 14th look like a very hands-off kind of guy.
But Jim, the government would never do these things. That the tax office would never target a political group. They would never target a group of people because of donations to different causes. They would never target protesters in any way. They would never target someone who's doesn't want to get vaccinated in any way. None of these things would ever happen.
Well, I know you're being actually very serious, but I know that's more rhetorical. The fact is, not only will they happen, they have happened, they are happening. This is the world we live in. That's absolutely the case. And let me give some concrete examples, because I don't put stuff like that out there without backing up. So in 2010, the IRS targeted what we call in the United States the Tea Party movement. This was the first midterm of President Obama's first term in office. Historically, a time when the president's party loses a lot of seats. It's not even Democrats versus Republicans. It's just a consistent pattern of first term president, first midterm election, they lose seats. Obama lost almost a record number of seats, something like 63 or 64 seats versus an historical average closer to 30. Because of people were upset about Obamacare, they were upset about the tax increases, the bailouts coming out of the 2008 global financial crisis favored the rich, hurt the poor. There was just a lot of people were having second thoughts about voting for Obama in the first place. So we had this Tea Party movement, and they just kicked butt in the 2010 election. Well, so these were springing up everywhere. This was a genuine grassroots movement. There was no nationwide top-down organization. Communities were like, hey, let's start our own branch of the Tea Party, et cetera. And because they qualified as nonprofit organizations, there's some rules around that, but you have to apply to the IRS, our Internal Revenue Service, for a designation and a number proving that you're a nonprofit organization. Well, the person in charge of those was slow rolling all the applications. They weren't getting approved. They were entitled to it. That the IRS intervened to squash the formation of Tea Party movements from coast to coast for political reasons, plain and simple. Well, that was 12 years ago, and there was no central bank digital currency. Imagine how much more powerful that kind of corruption is today.
There were $1 trillion of subprime mortgages. These are mortgages that, no documentation, don't have to prove your income, very non-credit worthy. But there was a bubble mentality, a frenzy, and everyone, hey, buy a house and borrow money, fix it up, sell it for twice as much, walk away rich, and everybody was doing it. Mortgage default rates rarely get above 5%. 5% is really high in the mortgage market. So people were saying, smart people like Ben Stein, the financial analyst, but the central bank and others were like, well, okay, let's get crazy. Let's assume a 20% default rate, which has never happened, but just assume that's true. On $1 trillion of subprime mortgages, a 20% default rate would be a $200 billion loss, which was only slightly higher than the S&L crisis of the 1980s. Adjusted for inflation, it would have been a comparable loss. And the attitude was, well, we survived the 80s, we'll survive this. Yeah, it's bad, banks will take losses, stock prices go down a little bit, but we'll survive. What they missed is, yes, there was $1 trillion of subprime mortgages, but there were $6 trillion of derivatives. Yeah. That was invisible. So all of a sudden, 20% of that was $1.2 trillion. So you create derivatives out of thin air, yeah. And there's no limit on how many you can have. They're off balance sheet, meaning give me the balance sheet of the company, I won't see them. You have to read the footnotes and then the information behind the footnotes. So non-transparent, unregulated, no limit on size. So the crisis was actually much worse than anyone realized. And then when it started to collapse, the contagion spread throughout the financial system. My point about 2008, it was because we did not learn the lessons of 1998, and we flew right into 2008. But once again, we have not learned the lessons of 2008, and we're going to fly right into the next storm. In 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. Who's going to bail out the central banks? In other words, the point is each crisis is bigger than the one before. The intervention gets elevated, larger dollar amounts. And are we now at the point where there's no one left to bail us out? And one of the questions I'm asked most frequently is, okay, Jim, I kind of follow your analysis on how risk works and how complexity theory and capital markets, how that works. But where's the crisis coming from? What's going to be the catalyst? It's actually a long list. Now, student loans, there are $1.6 trillion worth of student loans. So this will go, and kind of this gets to your point, Francis, how do capital markets and money markets and Fed policy kind of leach into debt and deficits? So when a lender, credit union, or anybody, or university makes a loan to a student, and the Treasury guarantees that loan, which they do, it's off budget. Again, it's not strictly a derivative, but it is non-transparent. So then the student defaults, and the credit union, the lender, simply turns to the Treasury and said, here's your loan file, pay me. And the Treasury pays the lender because they've guaranteed the loan. Now it's on the Treasury. But until that point, that loss is not on the books of the United States government. That loss is not part of the deficit. But when the Treasury writes the check to make good on the guarantee, it does go into the deficit. So we think deficits are high now, but there's this $1 trillion tsunami of student loan losses that's going to pile on top of the structural deficits and make it even worse. So all these things are, I spend all my time analyzing these things. I see them all. I can describe them. I can see how they're going to converge into a worse crisis. But in the short run, people either ignore them or they just don't know anything about them. But why would Bernie Sanders even suggest that? And by the way, he's not alone. I think the other candidates have, Elizabeth Warren and Joe Biden and Kamala Harris, one way or another, have suggested that they would do something similar, that we need student loan relief, and that ends up going onto the budget and onto the taxpayers. But there's a school of economics, and I talked about this in chapter 5 of my book. It's called Modern Monetary Theory, MMT for short. Everyday viewers, everyday people to know anything about it, but more to the point, economists don't know anything about it. This is a new school of economics, if you want to think of it that way. So there is this modern monetary theory, but the leading scholar of modern monetary theory is a lady named Stephanie Kelton, who's a professor at the State University of New York, but she's the financial advisor to Bernie Sanders. What modern monetary theory says is that actually there's no limit on the amount you can spend. You can spend as much as you want, and the market will either buy the debt, or if they balk, the Fed will monetize the debt. So how much debt is there relative to the size of the economy? This is called the debt to GDP ratio, but the way it's a simple fraction you learn in the 5th grade. How much debt divided by the size of the economy? So in a simple example, if you had $5 trillion of debt and a $10 trillion economy, that fraction would be 1/2. So you would say the debt to GDP ratio is 1/2 or 50%. Today, the debt is larger than the economy. Yeah. That ratio is over 100%. We have round numbers, about $23 trillion of debt and about a $22 trillion economy. So the ratio is about 105%, highest since World War II. That troubles me, it troubles other economists. But my friend Stephanie says, what's the problem? You could take it to 150%, 200%. 250%. By the way, that's where Japan is. Japan's at 250%. Greece is 175% or so. Italy's 135%. They're all still standing. Go to the Ginza, it looks like Times Square. So you don't see visible signs of stress. And here's the irony. Ben Bernanke would absolutely not agree with this theory, and he said so publicly. But Professor Kelton says to Bernanke, you proved our point. You were the one who took the Fed's balance sheet and quadrupled it from 800 billion to 4.5 trillion or so. You proved that you can print trillions of dollars of money without causing inflation, without causing high interest rates, without causing a run on the bank. So all we're saying is, you did it to prop up Jamie Dimon's bonus. We wanted to do it to forgive student loans. We may have different policy objectives, but the process is the same. What's the problem? Now, of all the things I've debated, for years I was dragged into Bitcoin versus gold debates, which I thought were silly. I mean, I don't like Bitcoin, I do like gold, but it's like fish versus bicycles. I mean, the debate never made sense to me, even though I did a lot of them. Of all the things I've had to rebut, this was actually the most difficult because it's superficially appealing. First of all, legally, it is true that the Fed can take their balance sheet as high as they want. There's no legal limit on the Fed's ability to print money. It is true that Japan has a much higher debt to GDP ratio, and they're still standing. It is true that the Treasury can borrow as much as they want, subject to periodic increases in the debt ceiling, which have never been denied. And the Fed can monetize the debt. So all the elements of the thesis are actually correct. So how do you refute it? And the answer is that legally it can be done. And if your goal is to print a lot of money and forgive student loans or give a guaranteed job or guaranteed basic income, whatever it is, in theory you could do that. But there is an invisible psychological boundary, and this is what the modern monetary theorists don't understand, and I don't think Ben Bernanke understands it. There comes a time when people wake up and they say, I don't know what's going on here. I don't have a PhD, but get me out of the dollar. It doesn't. And so, I'll buy gold. I'll buy silver, land, oil, natural resources. I'll buy a new car. Buy a house. Get me out of the dollar into something tangible, because I no longer trust the monetary authorities. I no longer trust the Congress. I can't believe that you're going to spend this much money without ceiling, without limit, without causing inflation. My inflationary expectations will go up. And the way to deal with that is to buy hard assets, starting with gold, but not exclusively gold. There, as I say, land, real estate, natural resources. They're all good. They're all good substitutes. At that point, interest rates will skyrocket. All of a sudden, the bond market will have difficulty selling it. The president of the Congress could take away some of the Fed's independence. All of these assumptions could come crashing down very quickly, very unexpectedly, and that's the problem with the theory.
The inflation peaked around 9%, but it has been coming down. It's still too high. It's still way above the Fed's target. They say we want 2%, but I've never felt that 2% was the right target for inflation. I always thought it should be zero. If you believe in price stability, you wouldn't want any inflation and you wouldn't want any deflation. You would want price stability. Now, of course, you're never going to get it exactly there, but the target in that world would be zero, maybe a little bit below, a little bit above, but you'd always be steering to zero. That means you're not stealing anyone's money through inflation. You're not enriching creditors through deflation. You're not distorting the allocation of capital by either one. You're just saying we want stable money. That's kind of the Fed's job. Then the question is, why is it 2%? And, I disagree with Milton Friedman on a lot of things, but Milton Friedman said zero. He didn't think it should be 2%. He thought zero was the right number. I agree with that. So why is it 2%? Well, the Fed has a rationale. The rationale is every now and then you have to cut interest rates to stimulate the economy, bail out the stock market. You just need a rate cut. And the evidence is pretty good that negative rates don't work. They have been tried for years in Japan, Switzerland, I believe Sweden for a while, and the ECB, but they don't do anything. They don't stimulate. In fact, they often do the opposite of what they're intended to do. Let me give you a concrete example. So the idea is if I cut interest rates, lower and lower, as a saver or an investor, I'm going to say, well, I don't like those low yields. I put money in the bank. I only get, a quarter of 1% or half of 1% or whatever. So I'll go buy some treasury notes or I'll go buy some stocks. And that's called the portfolio channel effect. In other words, by keeping rates so low, you make simple savings and liquid investments unattractive, and you drive investors to other investments, housing, stocks, bonds, whatever, commodities perhaps. And then that creates a wealth effect. And if my assets go up, I feel more prosperous, and maybe I spend more money, and that helps the economy, et cetera, et cetera. That's the theory. It's all garbage, by the way. There's very little evidence for the wealth effect. Assets go up, people feel a little better about it, but the idea that they turn around and spend more money does not hold up. The people with the most assets tend to have the most discretionary income. And, once you got a couple of cars and a couple of houses, and a decent wardrobe, you're actually going to go spend more money. Well, probably not. You'll probably save it or invest it. I'm not saying those are bad things, but the idea that it stimulates the economy is not true. But if you follow the theory and say, okay, lower rates force you into asset purchases, et cetera, wouldn't negative rates do even more of that? Because what happens with a negative rate? You have $100,000 in the bank and at a negative 1% interest rate. I'm the government or the treasury or the bank. I'm taking $1,000 a year. I'm taking 1% out of your account. So you're sitting there. You just say, hey, I just want to save $100,000. That's all I want. But with a negative rate, it goes 99, 98, 97. And the idea there is, well, now you're really going to spend your money because it's kind of use it or lose it. Again, these are the kind of theories But let me kind of ground that in the real world a little bit. What do people actually think? When they see negative rates, people say to themselves, there must be deflation coming. The economy must be in really bad shape. Deflation must be getting the upper hand. Why else would they go to negative rates if they weren't worried about deflation? And if they are worried about deflation, and they are, then I'm going to say more. We're far from getting people to spend. Remember, the dollar is worth more in a deflationary world. Your dollars are actually worth more. In real terms, a dollar can be just a bank account, can be your best performing investment in a deflationary world. If you have 2% deflation, then the real value of a savings account with zero interest goes up 2%. And that's probably better than what stocks are doing in that world. So people act rationally. They say, okay, we have negative rates. Central bank must be worried about deflation. If they're worried, I'm worried. And I'm going to save more because, first of all, those savings will do well in deflation. I need to be prepared for that. The last thing I want to do is spend. If prices are going down, why would I spend? I'll wait 6 months, get a cheaper price. So in other words, real world behavior is the exact opposite of what central bankers predict. Central bankers predict, use it or lose it, you'll go spend the money because I'm going to take it away. But real people say, no, I'm going to save more because you're signaling to me that the value of the money is going up because you're worried about deflation. The prices are coming down, so what's the rush? So for all those reasons, negative rates don't work. Now, in theory, cutting rates from 5 to 4 to 3 to 2 down to 0 does perhaps have some stimulative effect, not as much as people think. And so the Fed says, well, we don't want to start with 0. If we start with 0, if that's our target, and negative doesn't work, and the economy goes into a recession, how do we stimulate the economy? We can't go below 0, but we can't cut rates because we're at 0. So they believe that they ought to keep rates around 2%. Now, as inflation is about 2%, interest rates are about 2%. And that gives you 2 points of cuts. You could do in 25 basis point rate cuts, you could do 8 cuts. It's a full year of rate cuts from 2 to 1 3/4, 1.5, 1 1/4, et cetera. You can do 8 25 basis point rate cuts with 2%. So the Fed says our target rate is 2% because we need a little cushion in case we have to cut. And if we're at 0, we don't have a cushion, we can't cut. That's what they say. The reality is the following. And the way I explain this, it's like a little kid, like a 9-year-old kid, and his mother leaves her purse around. And the kid goes in the purse and sees there's $50 in the purse. And he says, well, even an 8-year-old will say, well, if I steal the $50, mom's going to catch me and I'm going to be in trouble. But if I take a couple bucks, she won't notice. Like, she's not counting the dollars every day. And the Fed's idea is if I steal 2% from you, you won't notice. 10%, yeah, you'll be up in arms. You'll be driving tractors up the steps of the Fed the way they did in 1980. But 2%, you kind of won't notice. Well, what's the math of 2%? Well, 2% cuts the value of the dollar in half in 35 years. It cuts it in half again in another 35 years. Bear in mind, you're starting from down half. So in a typical lifetime of 70 years, at 2%, the dollar is going to lose 75% of its purchasing power. So in 70 years, typical lifetime, your dollar loses 75% of its purchasing power at 2%. And that's really the point. Because 2% year in, year out, probably not enough to feel, but it's insidious. And by doing it for a long enough period of time, you destroy the purchasing power of the dollar. And that's what they really want to do. Why? Because the federal debt is nominal. But debt is nominal. If I owe you $1, I owe you $1. Whether in real terms it's $1.05 or 95 cents, that's separate, but I owe you the buck. Well, if you can destroy the purchasing power of the dollar, you're actually reducing the real value of the debt. People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. Good luck buying a loaf of bread because I've destroyed the value of the dollar. Now, 3% will do it in about 23 years, which means that you'll destroy 75% of the purchasing power in 46 years, not 70 years. So on, 4%, 5%, et cetera. At 10%, you cut the value of the dollar in half in 7 years. People like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years. Between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft, in small little bites, but do it long enough, you can get the whole thing and no one will notice. So they say we want 2% because we want to be able to cut if we have to. But the real reason is we want to basically erode the value of the debt and erode the purchasing power of the dollar in ways that you don't notice. And they can be very patient. That's how they do it. I would say that the Fed may actually cut rates sooner than Michael Wilson expects, and maybe sooner than a lot of Wall Street expects. And you say, well, Jim, isn't that good for stocks? And the answer is no, because the reason they're going to cut rates is because things are going to be much worse than even Wilson and others expect, which is going to cause the economy to crash. And then you will pivot, not because you want to, but because inflation might be zero, could be negative. We could actually be into deflation. We're already in disinflation. Disinflation is when you still have inflation, but it's coming down. That's disinflation. It's still coming, you still have inflation, but it's coming down. Deflation is when prices actually go down. Inflation is negative. It's not a question of going up at a slower rate. It's a question of actually going down. And then that feeds on itself. That's a central banker's worst nightmare, because people say, why should I buy anything? I'll just sit in my money and wait for the price to come down, maybe buy 6 months from now, or maybe wait a year. And then that feeds on itself. And then unemployment goes up, businesses shut down, stock markets crash, et cetera. And the Fed pretty quickly turns around and cuts rates. Now, we've actually seen this movie, and it wasn't that long ago. Go back to 2015, December 2015. That was the famous liftoff. Remember, interest rates had been at zero, I believe, for six and a half years at that point, the zero interest rate policy. And then Janet Yellen raises interest rates 25 basis points. Okay, it was a baby step, but at least they went up for the first time in 6 or 7 years. And actually, it was longer than that, because they were at zero for 6 years, but there was a series of cuts to get to zero. So the last time they had raised rates was even further back. That was like 2006. So that was more like 9 years. So she raises interest rates 25 basis points, and then waits a year. The next rate hike was December 2016. They waited a whole year just to go 25 basis points more, almost as if they would have been embarrassed if they had done nothing in all of 2016. I think it was the only reason they did it. But then when Powell came in 2017, that tempo picked up. It was like kind of nothing burger for a year and a half. But then Powell's like boom, 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 25 basis point hikes, and got the rate all the way up to 2.5, which doesn't sound like a lot, but considering that they had been at zero for 6 years, that was pretty steep. But what happened between October 1st and December 24th, 2018? The stock market collapsed. I mean, the Dow Jones, the S&P, and the NASDAQ all fell about 20%, just short of a bear market. It was like 19.8%, 20% to all intents and purposes. But that was in less than 3 months. And the Fed kept raising rates in the middle of the stock market crash. This shows you how out of touch they are and how behind the curve they are. So the last rate hike was December 14th or 15th. They got to look at the calendar. It was right around the middle of December, 14th or 15th. Even after 2 months of crashing stock prices, they raised rates one last time. They just kept going, and kind of what we were talking about earlier. And then finally on December 24th, what I call the Christmas Eve massacre, the NASDAQ fell 3% in one day. The Dow was like about 1.8%, S&P was over 2%, and the NASDAQ was 3%. And then the Fed got religion, like, oh, we went too far. We're the last to know, as always. So early January 2019, Powell said, use the word patient. It's one of those code words. It means, patient means we're not going to raise rates unless we tell you. So they were on pause. And then by late 2019, they cut rates. And then along came COVID. And by March 2020, they were back to zero. You had this huge round trip from zero in November 2015 to about 2.25, 2.5 in DC 2018, back down to zero by March 2020. And what was that all about? Well, the Fed went too far, didn't know what they were doing. The economy was weaker than they expected, and they raised rates. So bring that scenario forward to today. I feel like I'm watching the same movie, which is, okay, the Feds, they got the gumption, they raise rates. Now they're much higher than they were in 2018, but they're flying into a hurricane. They're flying into a very weak economy, seen by a lot of metrics: housing starts, global trade, ISM surveys, industrial output, inventories. There's tons of negative data. It's not the kind of thing that people doesn't make the headlines the way CPI does, but it's all there. It's hard data. So it looks like a bigger, badder version of what happened in 2018, and I would expect a worse outcome. So my point is, the Fed may in fact cut rates sooner than Wall Street expects, sooner than Michael Wilson expects, but not for good reasons, but for very bad reasons, because we're in a severe recession. So the bottom line is, we've had the supply side inflation. Now, we have not seen it come from the demand side, but let's say you're the Fed, okay? All you want to do is get inflation under control. You kind of don't care where it's coming from. You just want to get it down to 2%. So then the question is, okay, how is the Fed doing at getting inflation to the target? The 2% we talked about, and explain why that's their number. The answer is they're making progress, but they're not there yet. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said, inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know we'll probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so, in other words, too bad, Well, the Fed has no tools to affect the supply side. The Fed doesn't drive trucks. They don't drill for oil. They don't plant crops. They don't run tractors. They don't do anything that could alleviate the supply side problems. All the Fed can do is destroy demand, and that they can do. When you raise interest rates enough, mortgage rates go up, credit card rates go up, costs of working capital go up. All that tends to slow the economy, and it causes people to tighten their belts. But just think of the conundrum. The inflation is coming from the supply side. The Fed can't do anything about the supply side, but they can crush demand, which should reduce inflation. But how much do you have to crush demand when that's not the problem? It's coming from the supply side. How much demand do you have to destroy to actually affect the supply side? The answer is a lot. And this is what Jay Powell has been saying. Unemployment has to go up. We're going to be in a recession. We got to crush this thing before it gets out of control. And you got to crush it even more, because that's not even where the inflation is coming from. It's coming from the supply side. Supply chain bottlenecks have been alleviated to some extent, not completely by any means. And it was always a case of popping up here and there. It's not like you went into a supermarket and all the shelves were bare. It wasn't East Germany in the 1950s. But something would be missing. It could be the peanut butter one day, or the canned goods the next, or spaghetti the week after that. That has alleviated to some extent, not completely. But again, the reason it has been alleviated is a very bad one, which is that demand is down. In other words, the Fed is destroying demand, so people are buying less. So, grocers and retailers and boutiques and suppliers are able to keep more things on the shelf, not because all the logistics problems have been solved, but because the demand is down, because that's what the Fed's doing. So supply chain better, yes, but for good reasons or bad reasons? Well, it's for bad reasons, because demand is down. And that's another thing leading us into a recession. 2015. That's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. There are two huge fallacies in that narrative. The first one is, who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling you what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. But the second fallacy is even bigger. Is tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets, where you ended up losing everything, but for a couple of days or weeks even, it's the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment, and we're going to wake up with a severe recession, high unemployment, and a much lower stock market. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked. But it was a very close call. They would have shut down Tokyo and then around the world, London, and finally New York. And they would have opened days later. But that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference. There are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 19, 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, we may have a very bad recession, possibly worse than 2008. But 2008 is a model, and that may be what we're heading for, bearing in mind that these are two separate vectors. I'm going to spend $50 billion to create 51% of the mining capacity in the world, and I'm going to steal all the Bitcoin in the world and take down the Western financial system.
First of all, there's no such thing as cryptocurrency. There are 1,000 cryptocurrencies. In other words, you cannot speak generically about cryptocurrencies. Jim Rickards hates cryptocurrencies. That's not true. I really, really dislike Bitcoin, and I'll tell you why. But there are cryptocurrencies out there that I think are very interesting and worth your consideration. I'm for it. I'm against it. Cryptocurrency means nothing. You have to talk about the specific currency. And I'm showing Bitcoin, Litecoin, Monero, and Ether. By the way, isn't it fascinating how the graphical representation of cryptocurrencies is always a gold or silver coin? Bitcoin's gold and Litecoin's silver, Monero's both, and Ether is gold. I mean, what are they trying to say? I think that psychologically what they're saying is, well, this is nothing, but if we pretend it's a gold coin, then someone will buy it. But I just find this a little bit of an aside. But no, it's the same thing is true with fiat currencies. You can't be like or dislike fiat currencies generically. Some people do because they just hate central banks. I understand that. But it's a big difference between a Venezuelan bolivar and a euro. Big difference between a Zimbabwe dollar and a U.S. dollar. So in other words, don't talk to me about cryptocurrencies. Tell me what specific one you want to talk about, and that's a more interesting conversation. I think it's really important because this field is so muddied. The conversation is so muddied. People not distinguishing between blockchain and currency, not distinguishing between different types of currencies, et cetera. I think we need to step back, take a deep breath, and be rigorous in our analysis and think about what we're actually talking about. There's no such thing as a blockchain. There are hundreds of blockchains. In other words, every currency, every token, every so-called smart contract, if you're using Ether, has a different blockchain. So there are at least hundreds, perhaps thousands of blockchains, new ones being created every day. So again, don't talk to me about blockchain. Tell me which specific blockchain you're talking about, because they're not all the same, and this is critical. The main difference, there are many differences in this blockchain technology, but the main difference is validation. Because remember, the whole idea of cryptocurrencies and blockchain and the original Bitcoin and what Satoshi Nakamoto came up with is that we're going to have a trustless system. We're not going to trust banks. We're not going to trust clearinghouses. We're not going to trust exchanges. We're not going to trust central banks. We're not going to trust anybody. We're going to have a decentralized system that a community can validate, and we don't have to rely on anybody in particular. That was the original idea. So the question is, what's your method of validation? And that's what distinguishes one blockchain from the other. So I've listed 4 of them here, but there are others. Proof of work, that's what blockchain uses. And you know what the work is? You gotta factor these, 87-digit prime numbers into prime factors. It's a lot of computer crunching, completely clunky, completely inefficient, non-sustainable. I'll talk about that in a second, but that's Bitcoin. There's something else called proof of stake, meaning you actually, this is what Ether is based on, you demonstrate that you have a certain percentage of the processing power, so you step up based on your stake. There's proof of space. Space is storage space on a hard drive, so I get to vote on the blockchain. I get to vote on validating the blockchain because I've decided to devote a certain amount of my hard drive to that process. There's a new coin called Space Mint. And then there's the Byzantine Agreement, or Byzantine Agreement. There's a version of that called the Federated Byzantine Agreement, which I personally think is the best, much more robust to some of the problems we're talking about, and there are others. But the point is, don't talk about blockchain. Say, okay, what's your governance model? What's your validation model, et cetera? And then ask yourself, is that sustainable? Is that robust? Will that resist an attack? Are your cryptocurrencies going to be stolen? These are the questions you have to ask yourself, and there are no generic answers. So I cannot emphasize enough. Coin by coin. I hate to use the word coin, whatever, token by token, blockchain by blockchain. Be rigorous and ask yourself what's sustainable. Now, Bitcoin, Ripple, and Ether, and some of these other cryptocurrencies, not all of them, but the best known are going to fail. When I say fail, they're going to, Bitcoin might have a $200 value as a token for criminals. I think criminals and terrorists might find a use case at about $200 per Bitcoin, but they're basically not going to be anywhere near where they are today. Why do I say that? I don't want to make a claim without backing it up. The first point is they're non-scalable. Transaction times are slow. And then when you say that to Bitcoin people, they go, aha, the Lightning Network is right around the corner. Lightning's going to, we'll see. They said that about segregated witness. They said that about some of these other solutions. They don't seem to get community support. They keep forking the Bitcoin, meaning one day you wake up and there's 2 blockchains instead of 1, or whatever happened to that whole idea that we weren't going to have inflation and we weren't going to pull new cryptos out of thin air. But these solutions, you have to understand what the solution is. So what they're saying is, nobody has a solution for the inherent slowness, clunkiness, non-scalability of the original Bitcoin blockchain. There's no solution for that. So when you hear about solutions, what are they? Well, what they're saying is take a bunch of transactions offline. So everybody in the room could form a group, or let's say every coffee shop in Brooklyn, New York, every coffee shop in Vancouver could form a group. And all the people who want to buy coffee would join that group. And we would agree, so we're in our own little bubble over here, and we would agree that all of our Bitcoin transactions among each other don't go on the blockchain. They just get settled in this sort of separate cloud over here, and then we net them out. So, I pay you 5 Bitcoin, and you pay the person next to you 4, and he pays the lady in the back of the room 10, and she pays me 7, and we net it out, and then periodically, and it could be daily, weekly, monthly, or whatever, we net all this stuff out, and then we take that net and we put that on the blockchain, so that the amount of transactions that have to go on the blockchain is greatly reduced. That's true. But what are we doing? We've created our own network. I got to trust the coffee shops. How do I know they're not going to steal my money? In other words, it's only a solution because you're completely negating the original idea. Well, sure, if you want to tear up the original idea and start over, that's fine, but don't tell me you're adhering to the idea of a decentralized trustless network, because you're not. All you've done is create another network. Somebody, I get trolled on Twitter all the time. People tell me I'm an idiot and I don't know technology and all that stuff. And then my more sour moods, I tell them I was coding before they were born. But as far as some of these things are concerned, somebody said, well, you don't understand payment channels, and I actually do. And I said, yeah, I understand payment channels. We had those in the 50s. They were called party lines, which is, you pick up the phone and someone's talking, you got to ask them to get off the phone so you could go. In other words, there was an AT&T network, at least in the United States, but other people could jump in on this little side thing. That's all it is. These are party lines. So that doesn't work. Non-sustainable. The energy usage to solve the problem and make the proof of work in Bitcoin is now greater than the annual energy output of Ireland. Imagine taking all the electricity used in Ireland in a year, and that's how much we have to use to crunch numbers. By the way, every applied mathematician will tell you that prime factoring is a trivial problem. It's like an uninteresting problem. But it takes a lot of computing power to do it because the numbers are so big and the possibilities are so great. So we're just wasting the entire electrical usage of Ireland. In a few years, it's going to be the entire electrical usage of Japan. Who in this room thinks that governments are going to allow Bitcoin miners to use as much electricity in a year as the entire country of Japan, the 3rd largest economy in the world? That's not going to happen. It's not going to happen. It's not very green. It's completely wasteful. In other words, it can't happen. So that's why I say it's non-sustainable. It's going to hit a wall. Non-regulated, I don't have to remind you of all the frauds, new ones popping up every day. It's not just exchanges. Exchanges are, how do exchanges work? I want to go to a Bitcoin exchange. Well, you got to go in, you got to open an account, just like Merrill Lynch or Charles Schwab, right? So, or Toronto Dominion. So you go, you give me your name, your address, your social security number, your bank wire information, give them all that information, and then send them dollars. And they say, okay, you got some Bitcoin, here's your confirmation. Really? How do I know you didn't just take my dollars and send me a phony baloney confirmation? How do I know you're not, a Ponzi? You're using new money to pay off the old money. How do I know you're not Bernie Madoff with a computer engineering degree? How do I know you're not a bucket shop? How do I know any of those things? The answer is you don't. So good luck with that. Not to mention Bitcoin whales. They estimate there are 1,000 people who control 40% of the Bitcoin. Now you got millennials buying, 1/100th of a Bitcoin for, $10 or whatever the math is, $100. But you got these, I call them the whales, these 1,000 people who have 40% of all the Bitcoin. You don't think they have a big vested interest in keeping the price up? And you don't think they wash trade, do wash sales? So A sells to B for 10,000, B sells back for 11,000, A sells back for 12,000, B sells back for 13,000. This is called painting the tape. It's the oldest trick in the book. And there's no profit and loss because we're selling the same Bitcoin back and forth. But what we are doing is creating a ticker that gets the millennials, I shouldn't pick up millennials, 3 millennial children, but gets people all over the world, maybe a garage mechanic in South Korea took out a home equity loan or hocked his inventory, put his entire life savings into Bitcoin and has now been wiped out and is desperate and suicidal. That's what's going on. It's basically rich people stealing from the poor. Not a good business model in my view. And then finally, there's no use case other than criminals, terrorists, or tax evaders. Why is Bitcoin better than Visa unless you're a criminal? Now, if you're a criminal, I get it. If you're buying child pornography, you want to use the dark web and use some cryptos and all that. And if you try doing that with Visa, you'll probably get a call from the FBI. So I understand why it's good for criminals. But if you're not a criminal, if you're not a tax evader, if you're not buying child pornography, if you're not an arms dealer, if you're not a terrorist, then why is Bitcoin better than Visa? There's really no use case for it other than crime. And then it's not elastic. And this is important because there's a finite number of Bitcoins, 21 million Bitcoin. They're getting closer to that level every day. And everyone's like, this is a good thing because, the problem with central banks is they print all this money and we're going to have inflation. By the way, we haven't had any inflation for the last 8 years. Separate issue, I'll come to that if we don't run out of time. But, we hate central banks. They print too much money, blah, blah, blah. So we're going to cap the number of Bitcoin. But money supply has to be elastic. It can't be too elastic. The problem with central bank money is that it's too elastic. The reason, by the way, gold is such a good form of money is that it grows slowly. It grows at about the tempo of world growth. It grows at about the tempo of population growth. Not exactly, but close enough that it's the best form of money anyone's ever discovered. But the problem with Bitcoin, when you hit a hard stop, which they will, and the economy keeps growing, but you want to back it with Bitcoin, so here's your money supply and here's your economy, that's inherently deflationary, right? Because each Bitcoin's got to support more and more growth, meaning your Bitcoin is worth more in theory, but the problem is you never get there. Why? Because if you have a deflationary currency, there's no bond market. The money supply grows based on credit, based on loans, based on various forms of borrowing. The money supply is just a foundation, and the economy grows with credit. Nobody wants to borrow in a form of money that's going to be more expensive when you pay it back. I'm not talking about interest. That's always part of the equation. But I'm saying the money itself is worth more when you have to pay back the loan. No one's going to borrow on that loan, therefore no bond market, therefore no viable form of money. So these are all the reasons why this is going to hit the wall.
Just to kind of cut to the chase, the banking crisis is not over. The crises don't happen all at once in one day. They emerge, regulators deal with them, the other new investors come in, they go, it's all good, we got this under control, and then there's a quiet period, and then they just pop back up again. It's because they were never fixed in the first place. Let me explain why the banking crisis is not over. And for here, we're going to use a little financial history, which is underrated, but in my view, extremely valuable. Maybe just because I've been around long enough. I'm kind of a magnet for trouble when it comes to this. My first banking crisis was the Herstatt Bank in Germany in 1974. You have to have been around a while to remember that one. That was a foreign exchange. That was a bank where, in those days, if you were in Germany and the US and you were doing foreign exchange trading and you sold, it was Deutschmarks because it was before the euro, if you sold for dollars, you would, or bought them rather, they would deliver the Deutschmarks to you in German time and then you would pay the dollars in New York time. They failed in between. They got all the Deutschmarks, but they never paid the dollars because they failed in the middle of the day. And that started a crisis. But anyway, it's a long list. But let me point to two in particular. So the first one has some front row seat, 1997, 1998, the Asia-Russia LTCM financial crisis. Now, what people don't realize, people remember September 1998, LTCM's about to go under $1.3 trillion in derivatives. That's back when a trillion was real money. The Fed had no interest in bailing out a hedge fund. I was their lawyer. We didn't expect a bailout. We're like, why would the Fed bail out us? Why would the Fed do that? Well, the answer was, it wasn't about us. It was about the 19 banks that were going to fail if we fail, because they're dealers. So if they sell us, $1.3 trillion of derivatives, which they did, they buy them from the other side. And they're relying on the fact that they have a two-sided position and they make a spread. That's what they do. If one side of the trade goes away,
all of a sudden they're net short, they're naked on the other side, and they got to go out and sell stocks like $15 billion worth of stocks to cover the fact that they were long that much on their side of the swap. Well, I can tell you what $15 billion of fire sales stocks will do to the stock market if they would have closed the New York Stock Exchange, and a lot else beside. So technically, they were bailing us out. We got $4 billion in cash, put the fire out, but they were really bailing out Wall Street. We lost the money. Wall Street put in the $4 billion, but then Wall Street owned it, and they got all their money back a year later. But they put out the fire. But here's my point. That didn't start in September 1998. That started in June 1997 in Thailand. Thailand had a run on the bank. Dollars were leaving the country. They had pegged the Thai baht to the dollar, and people panicked. They said, because money had been going in for resorts and casinos and what else, and everybody wanted their money back, taking the dollars out. The Central Bank of Thailand could not maintain the peg. They imposed capital controls, said no more dollars, and we're going to devalue the baht, which meant for a U.S. investor, all your money was worth a lot less. That then pretty quickly spread through Asia, and then it went to Korea. But here's the point. It entered a quiet period. In December, January, February, things calmed down, and everyone said, it's okay. And by the long-term capital was fine. At the time, we were like looking into Asia for investment opportunities. But then it came back in April in a small way, because Sandy Weil was selling. He was merging city and travel. And he told the Solomon guys, I don't want any volatility in earnings because I don't want to mess up this deal. So you guys have to reduce your books. But the process of Solomon getting out of swaps widened the spreads. We're sitting there long term like, hey, spreads are blowing out, buy more. And then, of course, it came to a head in August. Russia defaulted on their internal debt, their external debt, and devalued the ruble. It was like a trifecta. And then that caused a panic, and then it got worse. And then finally the bailout at the end of September. But my point is, that took a year and almost a year and a half. It was a long quiet period in the middle. So just when you see a crisis evolving and then there's a quiet period, don't assume it's over. It just means that things have been patched up, but it's still percolating below the surface. The second one, of course, the 2007, 2008, 2009 global financial crisis. Now, what happened there? Everyone remembers September 15, 2008, midnight on a Sunday, Lehman Brothers files for bankruptcy, okay? That started in the spring of 2007. HSBC reported lower than expected earnings because mortgage losses on subprime mortgages were higher than expected. And that's when Bernanke, actually is on the record in the March minutes of the FOMC, said this will blow over. Yeah, and then it kind of came to a head in August 2007. That's when Jim Cramer and Aaron Burnett on CNBC goes, they know nothing. And Cramer was right. They actually didn't know anything. But the Fed kept the discount rate and they got the Fed funds rate. And then September, you remember all this, September 7, Hank Paulson's Treasury Secretary, he announced the Super Civ, special investment vehicle that was going to buy all the credit card receivables from all the banks with government money and then put them into a fund and work them out and all this stuff, which never happened, by the way. It was a dumb idea, but it never happened. But then in December 2007 into January 2008, what happened? The sovereign wealth funds bailed out the U.S. banking system. Abu Dhabi, and they were capped at 10%, but Abu Dhabi bought 10% of Citi, Temasek in Singapore bought, I think, 10% of Morgan Stanley, Kuwait Investment Fund. One by one, those sovereign wealth funds bailed out the U.S. banking system. So January, all good. February, it's all good. What happens in March? Bear Stearns blows up because it wasn't all good. That was the point. By the way, if you ever see a CEO saying it's all good, get your money out then. It's not that they're lying. It's just that they don't realize how quickly things can change. So then, so March, Bear Stearns blows up. What happens in June? Fannie Mae. What happens in July? Freddie Mac. What happened in August? The Congress passed legislation bailing out Fannie Mae and Freddie Mac. So once again, this is your second quiet period. It's all good. The Congress saved the day. Even though Bear Stearns, Fannie, and Freddie had just blown up, the Congress, in theory, bailed them out. It was all good. And that lasted about a month. And then September, here comes Lehman. So my point is, financial crisis can have one or more quiet periods. In fact, they usually do. Everyone remembers that when the Krakatoa erupted, but they don't know when the shaking began. They forget that these things usually have a year or longer. So if that's the case, and it is the case, those are just the facts, what should we say about the 2023 banking crisis? Well, we had this, again, March 9th, March 10th, March 12th, March 19th, May 1st, this sequence of failures, big ones, including Credit Suisse, we're in the quiet phase. Everyone thinks it's all good. So let's put a finer point on that, and I'll go through this quickly. Downward sloping yield curves. Now that yield curve is just the x-axis are the maturities, the y-axis is the interest rates. Yield curves are supposed to be upward sloping. The longer the maturity, the more interest you're supposed to get. If I'm lending to you for 1 month, I want a certain rate. If I'm lending to you for 10 years, I want a higher rate because I'm taking more risk, more bad things can happen. Well, the yield curves are actually going down. What does that mean? It means that the big money, the wholesale money, expects a recession, maybe a financial crisis, and they think interest rates are going to drop like a rock. So why would I take less on my 10-year note than on my 1-month treasury bill? Well, the answer is I think that 4% on the 10-year treasury note is going to look pretty sweet when rates hit 2%. So that's what the market is betting. So it goes back to collateral shortage, bill shortage, dollar shortage, shrinking balance sheets, liquidity. There's a whole global liquidity financial crisis coming. At the same time, there's this whole recession coming. In 2014, Brisbane G20, there was an uproar. Citizens were, pardon my language, they were just pissed off. The taxpayers bailed out the banking system, and all the billionaires kept their jobs. So Jamie Dimon, he's still collecting bonuses, Goldman Sachs, all of them. None of them failed. They would have failed, but for the fact that they were all bailed out. But the everyday Americans are like, unemployment's 9%. I lost my job. I lost my 401ks down 50%, et cetera. So there was a political reaction to that. So in Brisbane 2014, they came up with not the bailout theory, but the bail-in theory. And bail-in means that if a bank fails, the investors, the stockholders, the bondholders, the depositors, they have to basically pay off the creditors. They have to pay off the depositors, and only when there's nothing left would the government maybe chip in. So what? And they put the world on notice. The insured amount in Europe is 100,000 euros. U.S. is $250,000. But the whole world was on notice. That's all we cover. Over that, you're on your own. What the FDIC did on Friday was actually consistent with what they all said they were going to do in 2014. It was a bail-in. And if you had $1 billion deposit, you're going to contribute to the rescue. Within 48 hours, they did a 180-degree turn. They completely blew away the $250,000 insurance limit. They said, we're guaranteeing all the deposits, multi-billion-dollar deposits. By the way, a dirty little secret about what happened at the White House. I said that, the Silicon Valley billionaires were crying about all these little startups and all this stuff. The truth is, a lot of what Silicon Valley Bank was financing was green technology, but they were in the White House sweet spot by saying green, and they were. That was actually what they were financing. Everyone thinks, oh, somebody's working on an app. They weren't apps. They were like battery power. So they get bailed out. At the same time, on Sunday night, now we're talking March 12th, they closed another bank, which was Signature Bank. Something about S, Silvergate, Silicon, Signature, all the S's were going down. Now, Signature Bank was another interesting case, which was Barney Frank was on the board of Signature. And if that name rings a bell, just think of Dodd-Frank. Dodd-Frank, 2010, 1,000-page legislation. I know I met Barney. I know Chris Dodd very well. That was supposed to solve all the problems of the 2008, 2009 financial crisis, et cetera. Here, the author of the bailout legislation is on the board of the bank, and his bank gets shut down. Well, what's up with that? They bought government bonds, and when interest rates went up from 10-year note, treasury note yield to maturity went from 1 3/4 to 4. All those bonds lost 80% of the value. That's what happens on long duration bonds. Bond math is simple: rates up, price down, vice versa. While the rates were up, the price was down. So they were underwater and insolvent, and they got shut down. So Barney Frank's out whining the next day. He's like, hey, yeah, but that's true of every bank in the country. There's not a bank out there that didn't load up on treasury bonds at 1 3/4. They're all underwater. They're all insolvent. And by the way, the Fed announced a facility, but basically what they said was, if you're a member bank and you have treasury securities that are where the mark-to-market value is below par, so you paid $10 million, but they're only worth $8 million. And that was the case across the board. So like $1 trillion or more of bonds that were in that category. You can deliver them to us, and we will lend you for 1 year the face value. So you're putting up 80 cents of collateral, but you're getting a 100-cent loan. I said, I got a 15-year-old car. Will you lend me what I paid for it? Because it's a lot more than it's worth now. But that's what they did. So now now my head's spinning. I'm like, well, I mean, I get all this stuff, but I'm like, oh, so you just guaranteed every deposit in the banking system without limit, and you just guaranteed every treasury bond at par value without limit. What's left? Like, what else do you have in your bag of tricks? Because you don't have it. There's nothing else you can do. Go back to 2008, they guaranteed every money market fund in the country. So, but here's Barney Frank whining, hey, yeah, my bank was in trouble, but so was every bank in the country. Why did you whack me and give all these guys a pass? Well, the answer is Signature Bank was another crypto bank. It had a portal called Signet. And Signet was a portal to the crypto world. And that's why they whacked it. Notice they whacked 2 crypto banks. Everyone's asking Janet Yellen, it's like, wait a second, what just happened? You guaranteed every deposit in the banking system. And she's like, well, no, not really. It's only if you're systemically important. And you're like, okay, could you please define systemically important so we can tell? Because we're getting our money out of all the banks that are not. And the truth is you can't, because the system is so densely interconnected. And this is why they say financial contagion. I mean, it's a metaphor, but actually the mathematics of a viral spread, we just went through a pandemic, but this has been true, for as long as it's been studied. The mathematics of viral contagion are identical to the mathematics of financial contagion. The equations are the same, the way it spreads. And of course, Janet Yellen can't define systemically important. Number one, they try, but they can't. Number two, I don't care how small you are. If you're a small bank and there's a run, the guy across the street, he's getting his money out of that bank. And again, it's like COVID. It's like it just keeps going until the system collapses, which means by definition, just by the dynamics, there's no such thing as a bank that's not systemically important, because they're all connected. Even the little banks are borrowing from the big banks, et cetera. So Janet Yellen hemmed and hawed and didn't have a good answer. She never does. She's not that bright. And so there we are. So the Fed has guaranteed every bond at par value, even if you're worth 20% less. And the FDIC has guaranteed every deposit. And Janet Yellen can't give you a good definition of what's covered and what isn't. Okay. Now a week goes by. What's on tap for the next week? And again, Friday night press release, shotgun wedding, Credit Suisse and UBS. Now you're talking to big guys. These are 2 of the biggest, oldest banks in the world. I think Credit Suisse have been around since the 1870s, maybe, and I'm not sure about UBS, but they were the 2 biggest banks in Switzerland. So Credit Suisse fails, and they get taken over by UBS. Okay. And now everyone's like, what's next? Who's next? And there's a list. I'll go through it in a minute. What factors come into play? How can I think about whether a bank is likely to fail or not, regardless of whether they're getting bailed out? And there are 2 metrics that are really good. One is look at the ratio of uninsured deposits to total deposits. If that number is more than 30%, you're a sitting duck. And in Silicon Valley's case, it was 97%. They were 97% uninsured. So a little local bank that's got, I'll say 30% uninsured and 70% insured, they're very unlikely to have a bank run. Most of those customers are like, hey, I'm covered, I'm good, I got 100,000 in the bank, all good. But when you're up the, north of 30, certainly north of 50, 70, 80, 90, you're an accident waiting to happen. Yeah. The other metric is total assets. So there really are too big to fail banks. Doesn't mean they can't fail, but it means they're 100% guaranteed to get bailed out. And that list is well known. So who's too big to fail? Like, you can put your money in, they can screw up really badly, and you're not going to get hurt as a depositor. JP Morgan Chase, Wells Fargo, Goldman, the usual suspects, Goldman Sachs, US Bancorp, Capital One, TD, State Street, Citi, B of A, Morgan Stanley, PNC Financial, Bank of New York Mellon, Truist Financial, and BMO Harris. They're the giants, okay?
Right.
I'm not saying they can't fail. I'm saying that there'll be a safety net put under them, and no one's going to lose anything except maybe stockholders, but not bondholders, not depositors.